In early 2008, the global economy looked stable. Stock markets were functioning, banks were profitable. Housing prices in the United States had been rising for years. Governments, investors, and ordinary citizens believed the financial system was strong enough to handle almost anything. Many experts even described modern finance as safer than ever before. But beneath that confidence, something fragile had already begun to spread through the system. To understand what happened, we have to go back a few years earlier. In the early 2000s, banks across the United States began lending enormous amounts of money to people buying homes. Mortgages became easier and easier to obtain. Even people with unstable income or weak credit histories were approved for loans. These were called subprime mortgages. At the time, it didn't seem dangerous. Housing prices had been climbing for years, and many believed they would continue rising indefinitely. If someone couldn't pay their mortgage, the house could simply be sold at a higher price. It seemed like a system where everyone could win. Homebuyers could purchase houses they couldn't previously afford. Banks earned money through loan fees and interest. Investors could buy financial products tied to mortgages and receive steady returns. The entire system depended on one assumption: that housing prices would never fall. Banks did something else that made the system even more complex. Instead of keeping the mortgages they issued, they bundled thousands of these loans together and sold them to investors around the world. These bundles were called mortgage-backed securities. On paper, they looked safe. They contained thousands of different mortgages, which seemed to spread the risk. Credit rating agencies often labeled them as extremely secure investments. Pension funds, investment banks, insurance companies, and financial institutions across the globe began buying them. The system grew larger every year. More loans were issued, more securities were created, more investors bought them, and the deeper the system grew, the harder it became to see its weaknesses. By 2006, the American housing market had reached extraordinary levels. Prices had climbed so high that many people were taking loans they could barely afford. But the first cracks had already appeared. Housing prices stopped rising. When prices stopped increasing, the entire logic of the system began to weaken. Some homeowners discovered they could no longer refinance their mortgages. Others began missing payments. Foreclosures started increasing. At first, the problems seemed small, but because those mortgages had been bundled into securities owned by banks and investors across the world, the damage did not stay contained in one place. It spread. Financial institutions suddenly realized that assets they believed were safe might actually be extremely risky. But no one knew exactly how risky. The system had become too complicated. Banks had bought and sold financial products tied to mortgages through layers of contracts and derivatives. When mortgage defaults increased, no one could clearly see which institutions were exposed or how deeply. Trust began to disappear. Banks rely heavily on trust. They lend money to each other every day to keep financial markets functioning. But when uncertainty spreads, institutions become cautious. They stop lending. That is exactly what began to happen. By 2007 and early 2008, several financial institutions had already started collapsing. Investment funds tied to mortgage securities began reporting massive losses. Still, many people believed the crisis would remain limited to housing. Then came September 2008. Lehman Brothers, one of the largest investment banks in the United States, had been deeply involved in mortgage-backed securities. When housing prices collapsed and mortgage defaults surged, the value of those securities fell sharply. Lehman's losses grew too large. On September 15, 2008, the bank filed for bankruptcy. It was the largest bankruptcy in American history. The collapse sent shockwaves through the global financial system. Investors panicked. Stock markets around the world fell sharply. Banks suddenly became even more unwilling to lend money to each other. The fear was no longer about housing. The fear was about the stability of the entire financial system. Within weeks, governments and central banks around the world began launching emergency measures. Massive rescue programs were introduced to stabilize banks and prevent further collapses. The United States government approved a bailout plan worth hundreds of billions of dollars. Central banks injected liquidity into financial markets to restore confidence. Even with these interventions, the damage had already spread across the global economy. Businesses struggled to obtain credit. Companies reduced investment. Unemployment began rising in many countries. Economies slowed sharply as financial uncertainty spread. What began as a problem in the housing market had evolved into the worst global financial crisis since the Great Depression. Millions of people lost jobs. Homes were foreclosed. Savings disappeared. Governments accumulated enormous debt trying to stabilize financial systems. Looking back, many economists argue that the warning signs had existed for years. Rapid growth in housing prices, expanding mortgage lending to risky borrowers, increasing complexity in financial products tied to mortgages. But when systems function successfully for long periods, people often assume they are stable. The financial system had grown so large and interconnected that its risks became difficult to see clearly. Confidence replaced caution. Investors trusted ratings. Banks trusted financial models. Governments trusted that markets would regulate themselves. But complex systems do not always fail gradually. Sometimes they reach a point where small shocks reveal deeper weaknesses that had been building quietly beneath the surface. The financial crisis of 2008 did not begin with a single moment of collapse. It began years earlier, when the system slowly built layers of risk that few people fully understood. And when those risks finally surfaced, they spread through the global economy faster than anyone expected. The lesson of 2008 is not only about housing or banks. It is about how modern systems can appear stable even while hidden vulnerabilities grow beneath them. Because sometimes the most dangerous phase for any system is not when it looks weak, but when it appears strongest.